So today I want to talk to you about mutual funds. What are they and are they worth buying? Short answer, no, they're not worth buying, but more on that later. So Wikipedia defines mutual funds as professionally managed collective investment schemes. What does this mean? Think mutual funds are investing made easy. Mutual funds offer a selection of stocks, securities, commodities neatly bundled into a whole for you to buy and professionally managed by a stockbroker. So think you have a little money now and you want to buy a garden, but instead of buying individual plants and flowers, you buy a whole garden with pre-selected flowers and plants in it, and then hire a gardener to actively manicure it. Only in a mutual fund's case, you're in reality buying a share of this garden. But there are a few problems. While it sounds good to let the professionals handle the stock market, I can't help but wonder, whose interest do they have in mind? So nobody tells you this, but there are really two types of financial advisors. There's the fiduciary and the stockbroker.
Fiduciary, governed by the SEC and has to show clients' interests above their own. A stockbroker, governed by FINRA, not the SEC, and only has to show suitability. Big no-no.
So what does suitability mean? It means the stockbroker has to show that his investment purchases aren't unsuitable to the client's long-term investment goals. Who decides what your long-term investment goals are? Well, that's up to the stockbroker to decide. So how does a stockbroker earn his or her money? Three ways: through actively managed maintenance or management fees, commission on returns, which is great, or incentive, kickbacks from the securities issuer. Let's take Target as an example. Say Target wants to securitize a percentage of their stock to raise capital. They call up the mutual fund manager and offer an incentive or kickback to incorporate a part of their share into your mutual fund. And this in part incentivizes the mutual fund manager to add Target as part of your stocks and securities. Now remember, the stockbroker doesn't have to show you want Target in your mutual fund, only that it's not unsuitable to your long-term interests. Simply put, you're basically buying a mystery bag of stocks in the form of a mutual fund. Now you might say, perhaps, I like Target. Target's a good, strong, soluble company, and I don't mind having Target in my mutual fund. I agree, Target is a fine company. But what about when the mutual fund adds nebulous or less well-known stocks and commodities to your mutual fund? And second, how do you go about finding what exactly is in the mutual fund that you bought? To add some data, the SEC said they found many stockbrokers receiving financial kickbacks to point their clients towards funds that may have a lower rate of return and higher fees. Last November, Morgan Stanley paid $50 million in settlement fees to charges that it engaged in those same schemes. SEC said the practice is so widespread now, they discovered it happening at 13 of 15 major brokerage firms. However, the problem goes deeper than that. On the off chance your investor doesn't make some poor speculatory investment on your behalf, mutual funds become so over-bloated from the amount of securities and stocks packaged into them that any growth on one part is automatically negated by a loss on the other part. This almost always results in a net impact of zero. Fund goes nowhere, neither grows or declines in value. The only thing happening is the slow devaluation of your money through inflation. Standard mutual fund has been basically reduced to a market index, only one with actively collected management fees. And the statistics back it up. Decade after decade, mutual funds have been shown ineffectual at beating normal market indices. Despite superior marketing, the mutual fund has been empirically shown to be no better than any other form of investment. Some studies even argue they're worse than most investments. Lastly, if you're bold enough to even try peering into your mutual fund, the vernacular is so disguised and nebulous it takes hours to understand just exactly what stocks and securities you're invested in. So when it comes to mutual funds, just say no.